The chip boom that powered the entire AI revolution just hit a wall, and Korea's biggest semiconductor companies are bleeding billions. Samsung and SK Hynix crashed 9% in a single day, signaling what could be the first real crack in the AI data center gold rush. Here's what triggered the panic, what it reveals about the market, and why it matters whether you work in tech or just own a phone. For the past couple of years, semiconductor industry was riding pure momentum. AI companies needed massive chip orders for new data centers. Cloud providers couldn't build infrastructure fast enough. Everyone, from startups to megacorps, was racing to secure computing capacity. Memory chips, the kind that powers AI training and cloud operations, were the hottest commodity in the entire tech industry. But boom and bust cycles are the semiconductor industry's oldest story. And right now, the market is flipping from boom to bust in real time. SK Hynix and Samsung control a massive portion of the world's memory chip production. These are the chips inside every data center, every smartphone, every laptop. But they are expensive, and when demand suddenly cools, the impact is brutal. The first sign came from major customers pulling back orders. Amazon, Microsoft, Google, the hyperscalers that drove the boom, are slowing their data center expansion. Why? They built more than they expected to need. They're working through inventory. Some have even paused new orders entirely. And here's what most people overlook. This crash didn't come out of nowhere. It's the result of a perfect supply storm that's been building for months. The story starts 2 years ago. After the global chip shortage of 2021 and 2022, every major tech company learned the same lesson. You can't rely on external suppliers. Amazon, Microsoft, Google, Meta, they all began massive build-outs of their own AI and cloud infrastructure. Demand for memory chips absolutely exploded. Samsung and SK Hynix ramped production as hard as they could. They spent tens of billions of dollars expanding factories, new semiconductor fabs in Korea, the United States, everywhere. The industry was convinced that demand would stay high forever. AI companies needed more computing power. Each new model required more chips than the last. The math seemed obvious, but something shifted in the last 6 months. The hyperscalers hit a wall too. They realized they'd overbuild. The data centers were sitting with excess capacity. Training costs for large language models, while expensive, were not as astronomical as everyone predicted. Companies like OpenAI and Anthropic discovered you don't necessarily need exponentially more compute for each generation of AI. Sometimes better algorithms matter more. So Amazon, Microsoft, and Google all pulled back. They canceled or delayed orders. Those massive chip orders, gone, or at least postponed. Now factories built to run at full capacity 24/7 are suddenly running at 70–80% utilization. And that's where the crisis begins. To understand why this matters, you need to understand what memory chips actually do. There are two main types, DRAM and NAND flash. DRAM is the fast, expensive, temporary memory your computer uses right now. It forgets everything when you power down. NAND flash is the permanent storage, your hard drive, your phone's storage, USB drives. Memory chips are literally stacks of transistors etched onto silicon wafers. You can fit billions of transistors in a space smaller than a grain of rice. Samsung and SK Hynix perfected this process over decades. Their factories are among the most advanced manufacturing facilities on the entire planet. But here's the problem. Making memory chips is brutally expensive and brutally inflexible. A single fab costs between $10 and $25 billion to build. Once it's built, it's optimized to produce specific chips at maximum volume. You can't just switch gears overnight. When demand is booming, that's perfect. Run 24/7, maximize output, make huge profits. But when demand crashes, you're stuck. You can't suddenly stop production without losing enormous amounts of money on idle equipment and workforce. Supply and demand for commodities typically has a lag. Companies produce based on what they expect to sell. If expectations miss reality by 20 or 30%, prices collapse because you can't just flip off production. That's exactly what happened here. Everyone expected demand to keep climbing. It flatlined instead. Now the industry is flooded with unwanted chips. Amazon Web Services, Microsoft Azure, and Google Cloud all announced they are slowing data center buildouts. Amazon specifically told investors they are hitting saturation in key regions. They've got enough computing capacity for now. Microsoft, having invested massive amounts in AI infrastructure for OpenAI, is being more selective about new build-outs. Meta spent tens of billions on AI infrastructure. They're still paying off that debt and don't want to order more chips right now. Beyond the hyperscalers, smartphone demand is also soft. Apple's latest iPhones aren't flying off shelves like they used to. Samsung's smartphone sales are under serious pressure. Consumers are keeping old phones longer instead of upgrading. Fewer new phones means fewer memory chips per device. The PC market has been struggling for years. Consumers aren't upgrading laptops the way they did during the pandemic. Business PC purchases are moderate at best. The only bright spot was supposed to be AI. But here's the twist. Even AI demand is more selective than the industry expected. Not every AI company needs the same infrastructure. Some build custom chips. Others use different processor types. That means less concentrated demand for Samsung and SK Hynix's commodity chips. When almost every major segment of chip demand softens simultaneously, you get a crash, like we are seeing now. This isn't the first time the chip industry has crashed, but this cycle might be different. Back in 2015, the memory chip market collapsed. Samsung and SK Hynix saw prices drop 30–40%. It hurt badly, but that crash lasted about 2 years before demand recovered. Factories slowly ramped back up. The industry learned to manage inventory better. The 2018 downturn was worse in some ways. Memory prices crashed even harder, some segments down 50% year-over-year. That one lasted from 2018 into 2019. Samsung and SK Hynix both took massive losses, but both companies survived. They had the financial reserves to weather it. This time feels different in one key way. The scale of overbuild is bigger. Factories are larger. Production capacity is higher. And the demand pullback is synchronized. Everyone is slowing down at the same time instead of rolling back gradually. The other difference is competitive pressure. Korea's dominance in memory chips isn't as absolute as it was before. Chinese chip makers are improving. Taiwan's TSMC, while focused on logic chips rather than memory, is still a competitor for industry resources and talent. But here's where it matters. Samsung and SK Hynix have weathered these before. They have enormous financial reserves. Samsung is a mega corporation that makes everything from phones to TVs to appliances. SK Hynix has deep resources too. They'll survive this. The real question is whether the industry's trajectory has fundamentally shifted from explosive growth to slower, steadier expansion. What does this mean for AI? That's the question on everyone's mind. In the short term, AI companies actually benefit. Memory prices are falling. New AI infrastructure projects suddenly look cheaper. Data centers can expand more cost-effectively. OpenAI, Anthropic, and other leading AI labs might actually save money on their build-outs. But there's a longer-term worry. If Samsung and SK Hynix are struggling, they'll invest less in innovation. They might cut R&D budgets. They might slow development of next-generation memory technologies. That could slow the pace at which memory chips get faster and more efficient, which could eventually become a bottleneck for AI progress. For consumers, cheaper memory chips means cheaper phones, laptops, and storage devices. If prices fall 20 or 30%, manufacturers will pass at least some of that savings to customers. Or keep it as profit, depends on competition. But overall, lower memory chip prices are good for consumers. The real risk is if this becomes a race to the bottom. If Samsung and SK Hynix start losing money, they can't sustain operations indefinitely. Factories would close. Workforce would shrink. That would eventually cause supply shortages, which would spike prices again. The semiconductor industry needs both supply and demand to be stable. Right now, they are not. Samsung and SK Hynix are betting that demand comes back soon. If it doesn't, if the pullback becomes structural rather than cyclical, then we could see more consolidation in the industry. Smaller players would struggle, might even disappear. The next 12 months will be telling. So how do you stay informed about what's actually happening in the chip market? Here are the signals to watch. First, track memory chip prices. Websites like TrendForce and IC Insights publish weekly memory chip pricing data. DRAM prices, NAND flash prices, watch those carefully. If prices stabilize and start inching up, that signals demand is recovering. If they keep falling, that means oversupply persists. Second, follow quarterly earnings reports from Samsung, SK Hynix, Intel, and TSMC. These companies report revenue, profit margins, and guidance. When semiconductor manufacturers get more pessimistic about the next quarter, that's a leading indicator. When they sound optimistic, demand is probably improving. Third, watch cloud provider announcements. When Amazon, Microsoft, Google, or Meta say they're ramping data center builds, that signals confidence in future demand. Conversely, when they announce slowdowns or delays, that's a warning. Fourth, monitor shipping data and container volumes. There's a lag between chip orders and actual shipments. When shipping volumes drop, that reflects weakness a few weeks earlier. When they spike, growth is coming. Finally, pay attention to industry analyst reports from firms like Gartner, IDC, and Mercury Research. These firms track inventory levels across the supply chain. If inventory is building, demand is soft. If it's depleting, demand is returning. The chip market moves slowly, but the signals are there if you know where to look. Watch these metrics over the next few quarters, and you'll have a much clearer picture of whether Samsung and SK Hynix's recovery has started. Here's what matters most. The chip crash signaling this isn't hype. The AI boom was real, but it wasn't unlimited. The hyperscalers went all in on infrastructure builds. Now they're pausing to consolidate gains. Memory chip demand followed demand reality. Samsung and SK Hynix will survive. They always do. But this cycle teaches us something important. Even in boom times, there are limits. Companies can overbuild. Markets can saturate. Expectations can get ahead of reality. For investors watching semiconductor stocks, this is a reminder that the industry is cyclical. No sector grows at 50% year-over-year forever. At some point, growth moderates, prices correct. The strong players adapt. The weak ones don't. For consumers, lower memory chip prices mean cheaper devices over the next few quarters. That's a real win, assuming the price cuts actually reach retail rather than getting absorbed as company profit. For the AI industry, this is a gut-check moment. The infrastructure build-out isn't infinite. Demand is real but measured. This might actually force AI companies to be more thoughtful about compute spending instead of just buying more chips and hoping for ROI. The broader story here is that even transformative technologies like AI don't escape the basic rules of supply and demand. Booms create bubbles, bubbles burst, markets correct, and then, eventually, growth resumes on more sustainable footing.